Good afternoon. This is Jeff Scott. It is August 14th, 2016, and this is my top-down review. Switch this into presentation mode, and let's get started. I've entitled this one as Still Waiting as we continue to go sideways, and I just get this sense that we're going to break one way or the other in a big way. Will we see a melt-up, or will we see that correction that we're probably overdue? Enough of Wall Street's calling for the correction that maybe we get the melt up. All I know is volatility is pretty cheap. So if you're not sure what's going to happen, if you're overly exposed, buying protection is pretty cheap right now. But maybe it's cheap because the market's going up. But regardless, let's see what we see and make our own opinions based upon what the data shows. As always, this is for education purposes only. Any recommendations are in the spirit of education, not investment advice. I'm a doctor, not a broker. I am not affiliated with any software vendor or trading company. The tools I demonstrate are those that I use in my daily trading. I have paid for all the tools I demonstrate. Please note, I am friends with lots of developers, gurus, and educators, but I pay for what I've learned from them, and nobody pays me for saying things good or bad about them. Trading involves risk, and you alone are solely responsible for any decisions you make. Although I've spent a lot of my money on software education courses and reading books, just look at my Kindle, it's pretty funny of all the books I've read, I really come down to two trading philosophies that I mold together in my own way. One of them is based upon canceling, which is developed by O'Neill, improved by Morales and Katcher, made computer smart even before MarketSmith and Investors.com, both properties of O'Neill, which I subscribe to, by Ian Woodward and Ron Brown, who improved upon canceling. This is my buddy George Lee. He'll be doing another program. I'll probably be there in October in Southern California. Van Tharp, to me, the guru of position size and money management. And then what really put it all together for me, this is John Person. He's an author, trader, guru, educator, has a couple of neat indicators. And he's got some pretty smart ideas about position and trade management. And I put the two philosophies together, canceling plus JP, add money management, both from John and from Van Tharp, and a few of the tricks I learned from my buddy George Lee. I own every program you can imagine. If my wife ever looked at my desktop, she'd kill me. That's why I keep it pretty much clean. But what I only need is my TradeStation or Thinkorswim for trading. I use both. Genesis is a wonderful platform, but probably beyond what most of you are going to purchase. HGSi is my post and intra-market analytic platform. I think it does things I cannot do in other, but it doesn't at this point do John stuff. EdgeRater, great tool. I do that for some of my market analytics. I like seasonality. Right now, I'd say my favorite is Seasonality Trader, although I'm eagerly awaiting the relaunch of Best Choice for the web. And then I use a number of different websites. Speaking of websites, this is highgrowthstock.com. Once again, I get nothing if you go there. I get nothing if you buy it. What I do get is more users, which will keep the proprietor, George Roberts, in business even longer. If you go under investing strategies, you'll see my name. All my old webinars are there. I also look at Ron Brown. He does some great things, probably much more frequently than I do, and more geared, I think, towards using HGSi, even beyond what you'll see today. And up here, it says a free 30-day trial. If you haven't used it, I highly recommend it. If you do the trial, email me, and I'll send you a 6-pack of videos that I did a couple of years ago to help you get started. It is not as intuitive as I'd like it to be, but it's more powerful than any other post-market tool on the market. They don't even ask for your credit card. I'll have to talk to George about that. I don't think that's smart business, but it's great to be the customer. As I've mentioned many times, John is holding a seminar in September. I know it's filling up. It's September 24th, 25th, and 26th at the Hilton Garden Inn for $1,478. I added one day on the 23rd. It's optional. Those that came through the HGSi side into John, many of you are coming by. I just went to a bigger room so I could take a few more people. It'll also be at the Palm Beach Gardens Hilton on the 23rd from 9 to 5. $400 if you're only coming to mine, $300 if you're coming to John's. I also have packaged up some of my indicators and things to give as a gift to the attendees. Those would be indicators that I developed that I had created for me that I paid for that are proprietary to me, but no one else. Stock patterns are cyclical, and you have to know where we are. And for so long in 2015, we're at the top of this thing where every time it looked like we were going to roll over, we went back up for another leg. I think we're over here on the left-hand side, and we may have another big move up, but at some point we're going to roll over. And if we're not in a stage of uncertainty and flattening, I've not seen that. I've not seen it go this flat for so many days. Where we are determines what you do. I'm still leaning bullish, but as I said, premium is cheap. That means I didn't sell premium up here because I think that's a risky game. But because premium is so cheap, I did buy some put coverage on some of my positions. I did that as insurance. I will tell you, when I bought some puts on TNA, they got gobbled up so fast at the bid that it almost told me to cash them back out, because when I do that, when I see that somebody wants to take the other side of the trade, when I'm thinking negative, if they're so eager to take that trade, then the market's probably setting up to go higher. That said, puts on some of the high-flying indexes were pretty cheap. So over the weekend, I protected myself, and I've got stops in them, and we'll see what I do with them this week. I'm nervous that this market is getting close to a pullback, but it wouldn't shock me to see the market melt up before it rolls over. Friday was a flat, boring day. In fact, if you look at the spiders down here where my arrowhead is, they were down 0.09%. If you look at the Qs, I think I have them in here, they were up 0.07%. The Russells were up 0.01%, and the diamonds were down 0.2%. What a boring week. I think we went into the week with the spiders at about 218, 219, and we finished right about where we opened it up. It was a boring week for the marketplace. That said, there were plenty of things that moved. Just look at Acacia to the upside, and there were some pretty profound dumps. So if we look at Friday, I always like to see what was working Friday. Energy was working. Now, when I look at my Thinkorswim over the weekend, I see oil popped up over $1. I don't know if that happened after the market closed. Maybe there's some more talk about the Saudis. But energy showed some strength. Maybe it was already priced in the market here. Consumer staples started to move back up. Although it doesn't show much on discretionaries, it looks mixed. Some of the retailers like Bed Bath & Beyond had a pretty strong week, or strong day rather, on Friday. Utilities, more strong than not. Biotech seems to be holding stable as well. But a very mixed day without a lot of movement. If we look at the major market indexes, and again for these pictures, upper left corner is the E-minis, then the NASDAQ 100 futures, the Dow futures, lower left is the Russell futures, the VIX, and the dollar. Just to look quickly, we'll look at them where you can see them easier. We continue that slow grind up, although we're really going sideways on the major indexes. All of them, at least the first four are in a PPS buy signal for some time on the daily. The VIX is bouncing around its bottom, and the dollar is struggling to get above the 200-day moving average. On the weeklies, you can see how much of a nice move we've had. And again, we see PPS buy signals on the major weekly indexes. The VIX and the dollar we'll come back to later. This is just a chart I look at in Genesis, and I'm able to take a look at it just to get a sense of where we've been and where we came from. The top horizontally is the daily, then the weekly, then the monthly. And then vertically, we have the same things we just looked at, the E-minis, the NQs, the Russells, the NYSE, and the Dow futures. So what do I see here is I see that on the daily, it certainly looks like the ascent has slowed down. On the weeklies, we're still in buy signals. And on the monthlies, you could see the mess that we went through in the beginning of the year. But pretty much, we're back at new highs on everything except for, as you'll see, the Russell. I like to look at certain things every week to get a sense of where we are from an overbought, oversold, and also from a rates perspective. Now, what's interesting, at some point it looked like rates and the market were in parallel. And I think reality is until the rates get too high, if the rates signify a strong economy, the market correlates with that. We're in the opposite now, where the market's going up despite low rates. And I think it's an element of quantitative easing. There's no question if rates go too high, that will intentionally slow down the economy and could hurt the market. But right now, we seem to have a disconnect between rates and the market. The market gets higher, the rates get lower. And again, I think this is quantitative easing all over the place. And we have bounced off of record-setting lows on both the 10-year and the 30-year, but rates are still much lower than they are high. How often does a market tank from all-time highs on the AD lines? Well, as John pointed out to me this week, so they got to start somewhere, and most big market drops happened after a prior high. I think that's sort of a self-fulfilling prophecy there. But for all these charts, in white will be the index that we're looking at. In yellow is the spider. And you could see on the Russell 2000, the Russell 1000, both of them are tracking the same out to new highs on their AD lines. So big and or little and big. If we look at the S&P in yellow versus the NASDAQ composite here versus the NASDAQ 100, one can see a bit of a divergence as the NASDAQ 100, the largest 100 stocks of the NASDAQ, breaking out to an all-time high on AD, consistent with the index, yet overall the NASDAQ is failing. Here is the AD line pointing up, yes, but way below the high of the index itself. So some breadth issues perhaps on the NASDAQ. If you look at number of stocks above the 40-day moving average, which is over here, they pull back this week, while those above the 200 keep pushing higher. So what that tells me is longer term, we still are not at the worst of the oversold or overbought area. We still have a ways to go, though we did break this trend line. But shorter term, we become less overbought as we pull back. Speaking of some recent pullback, here is the 3-month new high, new low ratios. And you could see this is the extreme. Whenever we hit it, we roll back, and we've dropped down here. So a lot of the exuberance of the market came off in the last couple of weeks. So if the market continues to set new highs this week and some of the breadth is worse, that tells me a couple of things. That itself, from a conceptual perspective, is a bit of a divergence. And that could be a chink in the armor. That NASDAQ composite diverging from the AD line is a big thing. And then I guess is it a breadth problem that signifies the end? Or is it a good thing with a pause to refresh where we're becoming less overbought so we have some gas in the tank to go again? We'll have to see. The McClellan. Now this is probably a little bit more worrisome. The NASDAQ is currently, over the last few weeks or few days, couple weeks, making a new high. And notice what's happened with the McClellan oscillator. So you got a couple things here that are worrisome. You have a divergence in the McClellan summation index and the oscillator from the index itself. Now again, the McClellan's figured on the NYSE, and we're comparing it to the S&P 500. That's a kink in the armor. You also, on the daily chart, have crossed below the zero line on both while the market keeps going higher. If you look historically, that's something that might be a leading indicator that might expect the market to pull back. And then the other thing that's concerning is this a zero line reject on the daily, as we made higher highs but failed to take out the zero line. The point of this, and I learned this from John Person, so let me just call that out right now. He's an expert in this, and hopefully my interpretation is close to being accurate. This is a concern, as is on the weekly, where the same thing, we've got higher highs on price, but not on the oscillator. We've had broken below the zero line as well. Now, I changed out my McClellan pictures. I wasn't happy with the charts that I was showing previously. But everything I showed you, I look at every day. I do this in TCNet, TC2000, whatever it's called these days. And I just flick through one after another. These are easy screenshots for me to take because it gives me a great sense of what the market is doing in addition to some of my EdgeRater and HGSi shots. In EdgeRater, I run the buckets. So the buckets takes a look at the S&P 1500. It looks at each stock in that S&P 1500. It tells me two things. It tells me within the Bollinger Bands, how many stocks in green are above the midline, how many are below. A little bit bullish, but certainly not an extreme. I then take up between 0 and 100 being the lower and the top Bollinger Band. I break them up into 10 deciles, add one below and one above, and I see where the stocks fall. And this is a pretty, that's sort of a bimodal distribution, but that's clearly a non-oversold looking pattern. It doesn't really give me a clue. And so bullish, but certainly not an extreme. So we could be pausing to refresh and see one further leg up. But certainly all I can say right now is there's been some reduction of the overboughtness as well as some reduction in breadth that's participating. Now, the Hindi is something that we look for to give us a signal that the market is in a high volatile, near ready to fall perspective. Now, I'm not certain it still works. It hasn't thrown a positive in quite some time, but frankly, the market's not had a major setback. Now, it did have some positives on the Russell 3000, which is not the standard way, back in May. If you go back and look at 07 and 08, the last time we had a major top and a major correction or bear market, we were painting Hindenburgs all over the place. The Hindenburg has been around for years. Over the last 50 years, it's called all the major corrections. The Hindenburg consists of a number of technical factors. Both the new highs and the new lows have to be above 2.2%. The moving average of the indexes has to be going up, while the McClellan has crossed below zero, and the new highs can't be more than twice the new lows. So think about it. A lot of new highs, lots of new lows, reduction in breadth, but the market's still been going up. What that basically signifies is sort of that last hurrah where the professionals are selling off to the amateurs, we being the amateurs, the breadth is getting worse. And when those criteria hit and you get a couple of them within a couple of weeks, 3, 4, 5 of them firing, that should warn you that the market's about to undergo a major correction. We don't have enough new lows to be anywhere close on either looking at the NYSE and the Russell 3000. Classically, this analysis is done on the NYSE. It's automated within EdgeRater. I added the Russell 3000 just out of curiosity because of the fact that the NYSE has got so many bond funds and interest-sensitive stocks in it that I wasn't sure if it would still be representative of the market as a whole. Now, one thing that's also interesting is the number of stocks keep getting smaller. And I heard in several vehicles that the number of stocks over the last decade have dropped from 7,000 or 8,000 down to about 4,300. So that may affect some of these as well. And again, a divergent market where if we look at this third series here, we were in a nice bullish area, but now we're pretty much in a mixture, some strength, but we've got these red bars heading up. So the Woody indicator has gotten confused, and that just goes more with some breadth reduction and some divergence in the market. Now, let's look at some strength. Is this a triple top in the Canaries, or is this a breakout to new highs? I think this will be an interesting week. You know, if I think about the Canaries, Amazon's been steady Eddie. Facebook has been flat after a big move on earnings. Netflix is kind of the poopy one. Apple's broken out a little bit. Priceline's done okay. LinkedIn is going to have to come out because it's been a takeout. And then Tesla has been up and down with their takeover of Solar City. But as a group, they're looking pretty bullish as they're sitting right at the point that they've reversed in the past. Notice that everything is green up above. There's nothing red down below. It'll be interesting to see if we can take out new highs. The Canaries, to me, are always a leading indicator. They started rolling over in December, as the market did. In February, they turned around and sort of led a recovery. which they were leaders in. Just take a look at Amazon over that time. So I'll continue to watch that. Know your news and earnings. First thing is we're getting near the end of earnings, but if you have one of these, you're not near the end of earnings. Alarm's been a mover of late. VIPS looked good this week, but I passed because earnings were coming out. Fabrinet's also been a good one. So those who buy O'Neill stocks or O'Neill-like stocks will find some earnings that they have to be concerned about this week. News-wise, middle of the month, got some manufacturing. We got CPI, housing starts. We got some energy, FOMC minutes, claims. So when I look at this, do I think any of this is going to massively change the market? Probably not, although the retail numbers on Friday certainly did. Energy will be meaningful. It's going to take a major beat on some of these, such as CPI being too hot, claims being too many, for us to even start thinking about a rate cut anytime soon, a rate increase anytime soon. I think with the retail numbers that came in, people are starting to wonder about how long we're going to stay positive on the growth. And so I don't think you're going to hear as much saber rattling about rates. So I think that although many of these are market moving, the FOMC minutes will be interesting to see if they use it as an opportunity to talk rates. But I think it's going to be pretty hard for me to see how the Fed's not handcuffed again in September and maybe later on a rate hike, and they unable to do it even if they want to. Market thoughts. Rotations in place. Indices are grinding slowly higher with a mixture of breakdowns and breakouts. Volatility approaches historic low levels. Is it time to buy volatility? U.S. economy may be slowing down, which likely puts the Fed on hold, even with increasing employment. Bonds and stocks lead while metals, both precious and not, fall despite an easing dollar. As an EPS season wanes, will the U.S. election and other news events drive the market? Hillary is in the lead, and markets typically do well or better under Democratic presidents. If you think back to 8 years ago, this coming January, when Obama was being sworn in, the market was dropping 100 points every time he spoke. It's amazing how far this market has come since that date, and goes back to the fact that the market can do well under a Democratic administration. I don't think, frankly, that the market would like to see the Democrats get both chambers of the Senate and the House, as well as the presidency. I think the market would be okay with Hillary and with leaving the Republicans at least in one of the two chambers, sort of as a check and balance. And my gut says we're going higher, but with volatility so cheap, as I mentioned before, I bought some protection. Usual agenda. I do these charts of the week. Sometimes they blow up, sometimes they go up, sometimes they do nothing. This will be in the nothing to a slight loss week from last week. Stocks are presented for education purposes only. Trading, especially options, carries risk. I don't warrant any expectation of return. I plan on taking the trades as they execute, and I'm not doing this to provide stock tips, but to openly discuss how I take a trade and how I'm going to manage it. Last week I looked at Analem Therapeutics. Biotech had been strong. Everything was green. Broke out above the 200-day moving average. Pocket pivots and kahunas galore. OBV was strong. On the trade station, I had a breakout on the weekly in a PPS weekly, PPS daily, sort of a flag forming here, and I thought that this looked interesting. Now, the problem is the flag occurred after I bought the stock on Monday. It took out my buy signal right away, drifted down. It's still above the stop. You certainly could argue to be out of the stock on the same day I bought it as it failed. Could also be out because it's got a PPS sell signal, or you could still be in it with a small loss because it hasn't triggered our stop. If you think about how I take these trades, I limit my loss on the way in with a stop. And so I've left this trade on to follow. I took a small position. In hindsight, it's probably, as I look at it, I probably had come too much on the daily before I got in. And if I go back here, all we're doing is pulling back and testing that 200. A successful test at the 200 will be a very bullish sign, and that is why I stayed in, and we are above that at this point. So that's this one, and we'll come back to this current week's one in a few minutes. Do some housekeeping here. So let's look at last week. Last week was a challenging week, so I learned some things from last week. The S&P was up 0.05%. So I'm not expecting much of a return last week. Now, without looking at my position sizes, money management, options versus stock, just the names of my holdings were up 0.29%, but they're about 50-50. My filtered buys, which are my best buy list, was only up 4 out of 7 times, up 0.35. The GIF All-Stars were up to about 0.48. The MarketSmith 250 up 0.45. The IBD 50 was up 1.64, 2-to-1 winners. That was a great week there. Yet the HGS, which not even, it's about 50 now. Here I guess it was, or 60, was down 0.20. The things that were pulling back, pullbacks ready to run, bottom fishing, and pullbacks waiting for signal, were all negative on the week. So as I look at this, what was leading were stocks that were breaking out, Bible gap ups, extended stocks continued to do well, sprinters, leaders, although pullbacks to the 50 with a kahuna. So I would say growth more in vogue than not, but really a flat week, except if you were smart enough to have bought the Bible gap up. It was a single stock. It was Ashford Hospital Trust. Man, I looked at taking this one too. It was up 4.48%, but only 29 cents. All right, so I start by going into one of my TradeStation screens, and I look at one that I call Market Force and Divergence. I look at 5 things on every index here, and I try and go very quickly unless there's something to tell you. First thing I look at is person buy and sell in 3 time frames. The green arrow is a buy, the red arrow is a sell. This is daily, this is weekly, this is monthly. On the NASDAQ, we're in a buy in 3 time frames. The second thing I look for is the Elder Impulse Indicator, which is the color of the paint bar. A green bar is a bullish sign. I can be going long or holding. I shouldn't be going short. A red bar is a bearish signal. I should be short or holding. I shouldn't be going long. And blue doesn't tell me anything. It's neutral. So that's the second thing I look at. So on the shorter term, it's blue, and on the longer term, it's green. The third thing I look at is these red dots above, or I look at green dots that look like that on the bottom. And those are his MACD divergence scanner. And when I see those, I should be aware that we might be seeing some evidence of divergence. And if you think about it, look at the Elder MACD going down while the stock price was going up. That could be another kink in the armor. It can get divergent for a long time before the market corrects. The fourth thing that I looked at is the relationship between price and the envelope here. And I notice here that prices have a tendency to run up to the envelope or down and then track around it. When I see something big below the envelope, I get excited because I know it's time to buy. And when I get way above the envelope, it's time to get nervous and start to protect yourself. So, and then the last thing I look at is the high jump bar. And this shows me how extended we are versus the last 200 bars. We're at the 97% most extension in 200. So, NASDAQ, it's in a multi-time frame buy. It's got evidence of some short-term extension. I expect this to go sideways with that blue and the red dot. It's pretty extended on the high jump, so caution, but still looking bullish. Dow Jones Industrial, less extended on the daily, but blue with the red dots on the weekly. In a buy throughout, it's at 87%. The Dow, to me, looks like it has less pressure on it to correct right now. Dow looks pretty good. The S&P 500 looks just like the Dow. A blue bar, everything's buys a weekly, 90% on the high jump. The Russell, we'll use the Russell, the IWM, had one MACD dot here. It's blue on the 2 time frames, daily and weekly. It's still in a buy. So I look at these very quickly. Let's just look at the Qs very quickly as well. And Q looks a lot like the NASDAQ with some divergences and blue bars on the short time frame, but in a buy everywhere else. So no shocker, the market is clearly had a big run here, and it is at a point where corrections sometimes occur, but let the correction come to you. Again, premium was so cheap, and when I look at the S&P going sideways, I decided that I would buy some protection, and I look at triple ETFs, and I usually buy puts on, if the long is a big number, I buy puts on that. If the short is a bigger number, I buy calls on that. I find buying puts on instruments that are $5, $6, $7, $8, it's hard to make any money unless you buy a whole lot of them. So I'd rather go after the higher priced instruments. That's something that I learned over my time trading. But the markets look strong, and therefore I only took the protection to get me through the weekend. It was cheap, and I'm probably not going to hold on to them very long. Let's look quickly at the sectors. Materials. We got a sell signal. Gold and metals, steel sold off. That's something new. That's something to be concerned about. Materials had a nice run. All right, materials on a sell signal. Energy. Energy looks pretty darn good. It's in a buy with a nice green bar. Financials, I thought they might lead us higher. They look like they're rolling over. They're still in a buy. They've got the divergence. Notice a higher high and just a small participation here on the MACD. That just shows me that there's less participants trying to keep this up. So financials weakened quickly. Industrials still look good. Technology, big run up, getting extended. Staples back on the winning side with a new bar here. You could see they're actually in a weekly sell, but we'll see how quickly that reverses with a new daily buy. Utilities probably look like Staples. They haven't gotten a buy yet. They do have the sell here. Utilities will firm if this market rolls over, so that we'll watch them sort of as a contrary to the market. Healthcare, a new daily sell and a red bar. And then discretionary, where Amazon and some of these retailers live, still looks pretty good. So not the same market over the last couple of weeks with clear sell signals on materials, new buy signal on Staples, utilities in a sell signal, healthcare a new sell signal, and then discretionary with a new buy signal. So we're starting, again, it's divergences where not everything is working together, reducing breadth where not all the sectors are equally participating. This market is changing, folks. It's changing. Let's go into HGSi. Let's go into designer. Let's go down to full user groups, major markets plus. This is something that I would say Ian and Ron, but unfortunately we all lost Ian earlier this year. So Ron does for us and keeps up to date. So let's just look at them, and let's look at the top-down view, which is all price and volume, heavily weighted towards 1 day, greater than 5 days, greater than 3 weeks. And let's see if we can learn anything from this. Strength in the NASDAQ and the NYSE, gold, silver, down, volatility down, small stocks, and some of the big stocks. So medium-sized stocks, interestingly, doing better. Let's take a look and see if we get any other ideas about the market. Yes, I spend a lot of time on the market. There were kahunas on Thursday, but we're going to get out of this view and go into, well, that's actually a good view. I'm going to go look at I talk a lot about the Hindenburgs, and I feel like I'm wasting my time because I'm not convinced they're working anymore. So let's just look at them for a second. Let's go back. Here is 2006. Market ran up. We started seeing some Hindis here, and the market had a pretty extensive correction. Let's just take a look at how big of a correction that was. 8% in 26 days. Not a killer, all right? Then all of a sudden, we had a very long period of time. We had one spurious Hindi here, and yes, the market actually ran up and then pulled back to support. So really nothing there. So let me just see where this one took us to. All right. Didn't pick up this correction, which was how bad? 5.9%. Small correction. Let me make this a little bit, bring this in a little bit. I just want to get to the next time I see a positive Hindenburg. I think there's an, all right, here we go. A Hindi popped up. You know, we had a correction here. Again, pretty modest one. Let's call this one here out. 3.4%, a blip. And you notice we just fired again. So I don't look at that first Hindenburg. I look at when we get a series of them. From our initial low up to that first, well, to the high before then, we had a 26% gain in about a year's time. All right. I remember this well because I had just gone to India for my first time. And I'm sitting there and I go, God, that's a Hindenburg. Now notice what's happening. The market's not done much. All right? But you've had a series of shots across the bow. All right? If I saw that today, I am buying puts. I am raising cash. I am closing out my losers. I'm closing out my winners because I learned that this is not a time to be long. And then the market breaks down. That looks like a reversal signal. So it pulled down to the 200. So from the low it was only a 7.5% correction. Oh, look at this. So you had a failed here. So the ultimate correction was 12%. All right. So you may have gotten shaken in here. You really weren't doing much here. You certainly didn't get back above the 50. If you look up north, your bongos have turned red. I certainly would not have been getting back in the market here with the green bongo, the red bongos. So let's just see what happened. That looks like it may have been the low. Notice our bongos have gone green. Maybe it's time to go back long. And that got us up to our second peak in 07. So, from when these started, this is a daily chart. The market still went up until the ultimate rollover, 4%. You probably would have been better off in the bank or in bonds or in cash, because that 4%, we then had another signal. And again, when am I getting out of this? Right here. I'm getting out up here because this bar would have taken me out, went to a bongo red, multiple Hindis. So I'm getting out here, and I did get out there. And what happened with the market? So I did all that fancy stuff. So let's say we're getting back in over here. So the market dropped from that point. Another 20%. Before I had a buy signal, it moved up 9% already. So now it's all clear. And then my bongos went red. Actually had a small gain up there, 3%. And then with the bongos going red, this was the time here, the failure at the 200. But notice the Hindenburgs call the tops. You're not going to get Hindis to fall again until you get extended tops. And that was it. And the market, you did not want to be in the market. So I think this may be the low. So from the time that these Hindis kicked in, and I said this is the day that you would definitely have gotten out. Let's take the low on the 50. That was a 50% reduction in the market. So I may have stayed in it for 4% after after the Hindis fired, but if I didn't get out, I would have dropped over 50%. And that was there, she wrote. Now we get into the beginning of 09, retest successfully. March of 09, that was the signal, and that was the time to get in the market. And even a later buy off this 50 would have still gotten you in, and you made a ton of money. So if you got in it that day, and the rest, we all know what happened. The market had just a massive rally. Notice the lack of Hindenburgs. You should not see a Hindenburg again until that point where we get extended. So as much as it feels like we're extended off the short-term pullback, we're not extended over the longer-term perspective. It took us years to see any more Hindenburgs. Here is a pretty big correction in 2010. 17% for those that thought we didn't see any corrections. And then the market just continues to run. Not a Hindenburg in sight. Another big correction in 2011. %. Oh, you don't want to be long that. You could be using your bongos to have gotten you out up here. And still waiting to see that Hindenburg. 2012. Little correction year. $13. And I'm still looking for a Hindenburg. So we've had a massive run up, but not a correction. Now we're getting in towards 14. Talk about getting complacent in the market there. Big run up. And then the rest is history. So here we go. The first Hindenburgs after the recovery came in at December 14th. That was at 2072. And we go back here, we were at 660. So that was a 4 times run in the market from 660 to 3.5 times, 350% return. We're nowhere close to that. So maybe the fact we don't have Hindenburgs, that was the whole point of this exercise, is that we're not at any point close to being extended. So the other thing I wanted to do with this today that I thought was kind of cool is let's go back here and let's start looking at where we had highs in the past. Let's say it was in this area. Yeah, it looks about right. Hit the shift key. There you have prior highs. Well above it, above the moving averages. Bongos are green, no Hindenburgs. Let's take a look at the Dow. Let's kill all my drawings from the past. Now let's find the highs for right around in there. Broke through all-time highs, retested here above all the moving averages. Both bongos are green. Take a look at the NASDAQ. High somewhere in there, I guess. I think numerically we set a new high this week, and you could see we got above the line. So the NASDAQ, so the Dow, the S&P, the NASDAQ are all at new all-time highs. The bongos are green. And then the 1 week sister is the Russell 2000. But we have a long ways to go to take out new highs, and that's not even it. Let's try that again. That's where you got to go to take out the new highs on the Russell. We got a long ways to go. So the small stocks are laggards, and that is despite the fact from their bottoms, they are up 30% since earlier this year. Notice that my weekly bongo, all right, if you don't want to do a lot of homework, you buy when the weekly bongo is green and you sell when the weekly bongo is red. It gets you out late, but you avoided most of the pain, and then it got you back in. And the whole point about that bongo, weekly bongo, which isn't enough by itself, to be frank, is it's a great filter before you take longs or shorts. Everything looks green. It's hard for me to be bearish when I look at these things. Take a look at some of the other things that don't look as good. Let's take a look at the dollar. Dollar continues to struggle to stay above its 200-day moving averages. You can see the daily bongo is red. The weekly bongo is still green, so it's still in a longer-term uptrend. Struggling here at the 50. If the dollar is weak, you'd expect gold and silver to pop, and they're going sideways at best. Is this a trading range? I don't know. I have some nugget. I sold off most of my nugget. I still have a few gold holdings. I'm going to have a short leash on them. Silver, which has a few more uses from industrial, looks a little bit better, but it too is struggling here. And talk about what doesn't look good. Let's take a look at the VIX. Now, if I bring the VIX in here, oops. We are above the all-time low on the VIX. So we could still pull back some. That's not impossible. Boy, but this is certainly at a place over the last several years that we reverse from. So when the VIX is low, look out below. The VIX has got a bongo red, which says the VIX remains bearish. This is why protection is cheap. We know that we make our money when the VIX rolls over and pulls back, that when the VIX lifts off, the markets will fall. But it's certainly not lifting as of right now. And then lastly, I'll take a look at oil. Oil's in a weekly bongo down. Had a nice day on Friday. This is a USO. All right. Next thing I like to look at are the major industry groups, of which I have 171 now. And then of the 171, 48 are in a short-term gain. I see energy, department stores, semis, communication equipment, e-commerce, computers, biotech, energy, apparel, pharma, energy, pharma, technology. So I got some consumer discretionaries, energies, and some healthcares. I look at what's weak. Base metals. So my Techminco and Freeport rolled over, although really not that much over 5 days. I took profits. Oil gas services, so some of the drillers. Internet media, after some big moves, Meet Me gave up a little bit, drove it down. The rest pretty much nominal losses on Friday. Telecom carriers, again, nominal losses. Let's go look at the winners. Exploration and production, that's interesting, probably because it's a 1 or 2 day phenomenon. Resolute Energy. Now you notice only one group or one stock is above the group index. That's bothersome. Typically I only look at stocks above. Why would I want ones that are underperforming the group? Let's take a look at this one and look at a couple of them. Now, so I taught you about the bongos, the Hindis. I use the 17 is in green, 50 is in blue, and 200 simple are in red. If there's a magenta, then it's an 8-day exponential. This is a 1,000-day, which you won't see very often. Then I have OBV here with a moving average. Now let's make this dirty. I added to the bongos accumulation distribution and then force 13 and 2. This is my high jump bar. When it gets up near the high, it tells me that in an uptrend. Now, say that 10 times, in an uptrend, in an uptrend. Because if I'm not in an uptrend, it doesn't mean anything. It shows me the highest extension in the last 200 bars. That's as high as it got. That's usually a place where it reverses. The next bar is a Bible gap up. Then the yellow mustard is a squeeze. This is a mobile breakout. This is a group strength. Here's that 8-day exponential. The red dots and the green dots are the Wells Wilder PSAR. This is the earnings date, so I can get an idea visually of what happened after earnings. Here's my OBV and a moving average. This is a Eureka, which is calculated on the NYSE. When it's green, it's good. When it's red, it's a phoenix. It's bad. I have regular volume bars, and these are kahunas. Blue is good. Red is bad. Green is good. Red is bad. So Resolute looks incredibly strong, but when I look at a stock that in a month's gone from $3 to 14, I know this stock is extended. It's done that while its revenue has dropped. This makes no sense to me. Its earnings are nothing. I'm not sure if they're being bought. Now, they've got some big earnings coming in. That's kind of interesting. A ton of demand. Just look at this on a weekly chart. Coming out of a long base. It used to be an expensive stock. Well, you know, to me, it's run too far. But on the weekly, it doesn't look bad. I think it's gone too far, and I would pass. Devon, I have a position in this. This is more my style. A gradual increase. Everything is green up here. Had a pocket pivot this week, but doesn't have the earnings of Resolute. Oasis, pullback. It's out at the 50. I need some momentum to come in before I buy it. Marathon, I have this one as well. Moved up some this week, but really a slow mover. In Canada, I don't have this. Maybe I should have this. Looks like it's breaking out. Everything is green. So some overall oil exploration production looks good. Department stores moved on earnings. And Macy's and Nordstrom's and Kohl's, I had KSS at the money calls before earnings took good care of me. Macy's crossed up above the 200-day moving average, which it's been below for a year. On earnings with a kahuna, Bible gap up, mobile breakout from squeeze, everything is green. Look at this number in 2 quarters. My second quarter out earnings estimate from HGSi is never as accurate as 1, but it's still good. It pays a 3.6% dividend or 3.8% dividend. I like it. I like it. I like it. I like it. I like buying stocks that have been based. You know, the stock's been not so basing, but it had been moving up since May. Broke out on earnings. Everything looks good here. I think you can buy this stock with your stop just below the 200-day moving average. I like Macy's. Nordstrom's looks a lot like Macy's, doesn't it? Another Bible gap up on earnings. 2.9% dividend. It too, it's interesting. All right, this is this quarter. This has got to be the Christmas quarter. And it's comparing to this here, not to this. Big earnings expected for both these stocks going forward. Kohl's, same thing, pays a 4.5% dividend. It was sitting on the 50, gapped up through the 200. I took off half on Friday. Didn't want to be a pig. Bible gap up, mobile breakup from a squeeze. I left on. I had a big position, so I left on some. But Kohl's looks good as well. Department stores, even JCPenney with a nice move on earnings. So earnings are out. These stocks look pretty good. I have a couple of them. Semiconductors. Boy, I missed this puppy. I love what one of the guys I listen to sometimes, Dan Fitzpatrick, said. He goes, you know, I told you not to buy it back here because it was too far extended. Probably told you not to buy it over here because it's too far extended. because it gapped up after earnings. I get it. It's hard to buy that. I can tell you the same thing again here. Don't buy it. It's too far extended. This stock is one of the leaders of our time right now. NVIDIA, it's in most of your computers. They got all kinds of different things going. Their earnings per share growth looks like it's slowing down. It pays a dinky dividend. Its multiple is high, 40, but less than its earnings per share growth. Just keep tight stops. Bible gap up rules. Set your stop below the low of that gap up day. You're not wrong to want to play this. It's certainly exciting. I just think it's a higher risk play than I normally like to take. Micron, it had a kahuna on our pocket pivot on Friday. Everything is green, old name. Himax, this one looked even more interesting to me. Why? Took out the 50 and the 200, a PSAR reversal. Look how strong the group is. Mostly turning green up there. 2 kahunas in a row, and OBV dropped, bumped above its moving average. I like Himax. It made it to my chart of the week cut list, but wasn't the one that I chose. Acalero, what a nice looking chart. Pullback, breakout here. Mobile breakout from a squeeze. The bongo turned green up here. It's probably not too far extended. Bible gap up, mobile breakout, and a kahuna. Earnings are out. This one looks great. Look at these earnings per share growth. Gotta like that one as well. AMD, who would have thought? What a nice power move here. Pull back to support. I just have a hard time buying into this name. Semiconductors, wow, they all look good. Communication equipment, the winner of the week, winner of the lifetime. I wish I was long. I wasn't. Acacia, I don't know how I could buy it. Now I look for a pullback. Communication equipment, IPO, a 41% move with blowout earnings on Friday. To trade this one, you're going to have to go to different time frames, maybe 5 minutes, 15 minutes, and look to buy it at pullbacks. It wouldn't be wrong to expect some kind of flagging or something to occur, some type of a pullback, and use that to get in. But boy, this thing's on fire. Unfortunately, I missed it. Apple, longer term, it's a downtrend. However, the bongo went green when you crossed above the 50, and I'm referring mostly to the weekly bongo with a pocket pivot and strength in the market. That was the time to buy. It's had a nice move up there. I'm not a big Appleonian fan. I don't like its earnings per share growth, but they probably are one of the best retailers. And as I said earlier, retailers are kicking in. BlackBerry, talk about old names. Gapped up, spinning top, not interested. Arista Networks breaks out of this old high. Looks interesting. Look at the group strength. Everything's green. Finisar, I thought this was a takeout. All right, next group down, e-commerce discretionary. Yeah, this had a good week. I like a couple of these. Alibaba, as I said, there were some really big winners. These are what they look like. Alibaba, big breakout on earnings. Lots of pocket pivots would have got you in beforehand if you were paying attention. Earnings per share growth picking up. Kahuna, Bible gap ups 2 days in a row. Boy, this was a nice Bible gap up if you had bought the one in between here, but that was the day of earnings before earnings came out. Alibaba looks great. JD.com, I did buy into this one on Friday early. It also made it close on my list for chart of the week. Everything is green, came out of a squeeze, gapped up, a little bit of a short flag, and broke out with a kahuna. New PPS buys, by the way, and I think on weekly, if I remember correctly, also had an HCD if I had a kahuna. So I like JD.com, don't like its earnings, like the chart pattern. Obviously, the 200-day moving average will be concerning. Netflix, kind of going sideways, trending down, not my favorite. VIPS also looks interesting, but keep in mind it's got earnings on Monday. Great group strength, broke above the 200. Boy, if I could buy this coming back off the 200, I'd be happy. This used to be a high flyer, had a 7-to-1 split or something ridiculous like that, and it's been languishing ever since. Just going up, I can't miss Amazon. Amazon looks a lot like the Canaries, just a big gradual move up. This is not one. I mean, first of all, I have a big position in Amazon, so I'm happy about that. As I've said before, I actually I managed it with some options, so I didn't take the full hit, but I hung on for this pullback. I hung on because I'm an idiot. I hung on because I looked at the short-term tax gains. I hung on because I was too much of a believer. I hung on because God only knows what I was thinking. I was too busy at work. Like I said, during that 30% pullback on a $600 stock, which is about 220 points, I held in, and I got a couple thousand shares of this thing. Fortunately, you can protect yourself by selling calls above the price, by buying puts. Don't do put spreads if you think the stock's if you're looking for protection, because I ended up not getting full protection because I did some put spreads. I had bought long a few hundred points earlier. I didn't give up all my gain, but I started thinking that I was doing a round trip. Again, the option saved my ass. I would have been better off waiting till I saw this signal down here. And what do I have here? I have a clear island reversal here. One of these bars will count as a high closed doji. Probably this is the bar that's the high closed doji. That gets you in on the next bar. And from here, you would have had a gain of 50%. So I managed it poorly, except, read my lips, I protected myself with options, which means I'm paying insurance. I have a crap load of life insurance. When I die, my wife will be rich. My kids will be rich. I get nothing out of it except I know that in the case of a disaster, my family's taken care of. I hope to never use my life insurance until I get really old. I buy puts to protect my assets. I buy protection just like I buy life insurance. Hopefully I don't use either of them because it means something happened to my assets on the stock market. But the puts saved me. I would have been better off taking the cash out and buying it cheaper. But I love it. I still love it. I'm holding. And someday I'll have to take profits. I sell calls out of the money against it all the time to reduce my cost position. And I only buy puts when I get nervous. And John's weekly buy and sell signals have been pretty good on helping to capture those moves. So, a lesson in what not to do, or how we're all human. Computer hardware and storage. This is a buyout, so Silicon Graphics got taken out on Friday. That lifted the list, so we're not going to look at that anymore. Now we're going to look at Net Appliance. This is a really old name, but it's broken above the 200. Everything is green. It had some pocket pivots. I don't know if they're in the cloud space, but that might be a name to take a look at as well. NetApp. Back. Biotech. I've been long LABU. There's been some goods, bads, and uglies here. Good. Tesaro had some great data, which caused this move. It looks like a takeout. It was just an incredible day in the market for them with some great data. They don't make money yet, but they've got some exciting cancer products coming. Ariad tries to get bought at 12. It did this before. It didn't work up here because they wanted too much money. They've actually got some new data and some new drugs coming. I think this is also a takeout candidate, i.e. like Medivation, which ran from 27 up to 62. It's going sideways as it's auctioning itself out. Puma, I like this chart. Let's go to the weekly so we can see some more history. Used to be an expensive stock. It became a cheap stock. It's less cheap now. Notice the bongo green, had I been following this, could have got me in back here when it was a lot cheaper. It's now broken above the 200. It's got some new data that came out. It could be a get on a plane trade as it's right below the PSAR dot. All right. Integrated oils. These have been kind of hard to believe they're on the winners list. Exxon bouncing around after a pullback, did have a high close doji here. OBV did pick up. I may look at that in John's stuff. Chevron, a little bit closer to the moving averages. I like that better, 4.2% dividend. Petrobras, a lot of political, maybe tailwinds, not headwinds. So that was my top 10. And midstream, number 9. Big dividends on some of these players. I liked ETE. Not doing much here, but pays a 2.4% while you wait. ETE, some growth, been sideways for a while, pays a 6.6% while you wait. Williams Company pays a 9.8. OKE pays a 5.3. Looks like it wants to move, pulling off the 50 out of a squeeze with a pocket pivot. So these are good dividend payers with potentially some growth if oil comes back. And specialty apparel, take a look at a couple of these. Ross Stores has been just a long-term winner. Hope Lou Powers, his wife, still owns this. She's breaking out to multi-year highs here, if not all-time highs. Let's look at monthly. All-time highs. All-time highs. Retailer, Ross Stores. Something tells me in a few weeks we'll have new all-time highs. All green, makes money, small dividend. Foot Locker failed at the 200. I wouldn't touch this until it broke above and possibly retested it. TJX, nice uptrend here, all green, had some pocket pivots, OBV supportive. American Eagle Outfitters, look at this puppy. Breaking out, all green, kahunas. So there's some strength there as well. So there's a lot to like in this market. There's a lot of things that have done poorly as well. In fact, let's just go into the all securities and let's look at some bad performers. Sherwin-Williams breaking down here. I'm just looking at some of the big losers this week. I said there were a lot of losers as well as there were winners. Chipotle has been struggling. Here's one of my favorite stocks that's giving it up. Huntington Ingalls Industries. Now the funny thing is this a buying opportunity or time to be running for the hills? Makes money, small dividend. They do a lot of refurbishing of aircraft carriers, which still are what differentiates our military. The 50 day has been a good place to buy, but here's a stock that's come off of its highs quite a bit. So there have been some losers to go along with the Acacias and the other big winners. Why did I get out of my steel position? That's why. Now, we might be getting to a point where you want to get back in. I got shaken out here. Fortunately, I got back in. Kind of looks the same way. So it'll be interesting to see, looking at the fundamentals going forward. Earnings are already out. I may want to be in steel, but I'm going to wait to see where it pulls back and bounces. I don't think TCK looked as bad. Let's take a look. But I also got out of that. Hasn't fallen yet. That may have been a premature getting out of. Also got earnings coming in. AK Steel blew right through the 50. So even though the 50 looks like a great place to be looking to buy, this is why I got out of U.S. Steel, because I don't know when it's going to reverse. Its earnings are good next quarter, but then they drop off. All right, let's take a look at some of my buy list, and then we're going to go look at the chart of the week, and I'll show you a couple of other things that I do. I don't know where I put my buy list. Hold on a second. Let's go to designer. All right. Where'd it go? Oh, hold on. Now I got to figure out where I put that thing. File. I must have screwed something up here. Oh, all right. Hold on. Let me just save it from my other computer. 1 second. I did something to it that I don't know, but I can reproduce it very quickly. All right, designer. I guess one of the advantages of having so many computers, export user group, is that I have redundancy. Okay, I just brought it over, so let's now bring it back. File, import. Oh, I was hitting the wrong one, I bet. All right, there we go. Sorry about that. All right, a lot of stocks made my list. Many of these we've looked at already. I'm going to go through quickly and show you some of the things I liked and why I liked them. Many of them we've already seen. And then I'm going to go to my chart of the week. How are we doing for time? I don't want to go much more than... Okay. Ligand Pharmaceuticals. I've liked this one for a long time. Over a long period of time, when it pulls back to support, it's been a good time to buy. It's a couple bucks above support. I'd be watching Ligand if you like buying things that bounce. 5 Prime Therapeutics has pulled back to support. It's on a buy list. I need to see some momentum. Huntington Ingalls, again, I just showed you this as one of the losers. It's sitting on support. Give me a kahuna that's blue or a pocket pivot. That's when I like to get into these. Northrop Grumman, same thing. It's pulled back to support. It's not ready, but I'm building a watch list in case this market makes a run up. Paycom Software, a nice leader. Pull back here, breaking out of a flag. I like that one a lot. Centene, another pullback to support, waiting for momentum. So this goes on to a watch list, and I'll show you how I use these. ETE, we talked about it, pays a 10% dividend going sideways, place to park your money. XPO, a trucking logistics company, broke out here. It's got a flag, so I have to put in and buy it when it breaks above the trend line there. Great earnings per share growth, does not pay a dividend. This one, OBV, looks good. Pull back to support, looks like it wants to run again. Do your research. I'm just looking at charts. Here is a REIT for Education Reality Trust. Pulled back, pays a dividend 3.2. I'm looking for momentum. This is a shopping list, not a buy list. I say watch. If I want to look at regional banks, I like Legacy Texas, sideways, mobile breakout from a squeeze, good earnings coming in, 2% dividend. Here's TCK. I want to wait for it to pull back. Don't know this company from Adam, but I do like a mobile breakout from a squeeze. Kahuna, everything is green. It is a small biotech, Minerva Neurosciences. Medical Property Trust. I've looked at this one in and out of it. It's a REIT rolling up healthcare offices. Good earnings per share growth, pays a 6% dividend. You're buying it right on support. Maybe look for some momentum coming in. Lowe's Corporation on support, had momentum this week with pocket pivots and kahunas. Prospect Capital, I call this one sort of a special situation. It's got no earnings per share growth to speak of. Revenue's kind of flat. It pays a 12% dividend. Mobile breakout from a squeeze right below the PSAR dot. I like that dividend. I have to admit it. Media General, sideways consolidation, content creator, I believe. No dividend, great earnings per share growth, sitting at a good buy point with a kahuna. Mobile breakout from a squeeze, everything's green, can probably be bought right now. Five Below, a consumer staple, sitting on support, had a mobile breakout from a squeeze. I'll be watching it. Here's another special situation, very flat mover, did get above the 200 and a PSAR breakout and a pocket pivot out of a squeeze and pays 11.2% dividend. KKR pays 4.3% dividend. Medley Capital pays a 16% dividend with a kahuna out of a squeeze. Penny Park Investment Theme pays a 14.7% dividend with some growth potential. Beacon Roofing, here's another one, pullback to support, what's been a good mover, kind of loose, looking for some momentum. Western Gas, boring, flat stock, did have a pocket pivot and a kahuna and pays a 6.7% dividend. Here's that Puma Biotech. Here's a REIT that pays a 4.5% dividend. I like the kahuna. And mobile breakout from a squeeze, everything is green. Aris Group, this is a technology play. Cabot Oil and Gas, this was an interesting energy play. Mobile breakout from a squeeze and a couple of kahunas. Anything here, I'm getting tired. You're probably getting tired of listening to me. Nah, we're good. Of course, I was looking at these from what scanner? I was looking at the worst players first. So if I want to look at the best players first, I would do this. And some of them would be the same. Alibaba. So we'll just go backwards and look at some of the top performers. We looked at Alibaba already. Here's Nordstrom we looked at. Here's Kohl's we looked at. JD.com we looked at. Resolute we looked at. Vips we looked at. Sunrun is a renewable energy play. It had a mobile breakout from a squeeze, lots of kahunas. I'm interested in watching it, not buying it. It's got to get above that 200. HiMax, pull back to support. This is really a bottom candle to me. A couple of kahunas, everything is green. Great earnings per share growth. HiMax used to be the makers of Google Glass. That didn't work out so well for them. Looks like they want to go higher. We looked at Acalero, looked at Ross Stores, looked at Amazon. Here's a biotech company. I don't know anything about them. They've been flat forever. They had a couple of kahunas, a pocket pivot out of a squeeze. Again, I'm going to watch them. Fabrinet's got earnings this week, lower left, upper right. Here's YY, another Chinese retailer. Ambarella, I think highly of. Broke out here, retested a couple of times. This was a good time to buy the stock. It's had a nice move. Here's another oil play sideways. I think we talked about this already. I don't want to talk about that one yet. Horizon Pharma, a specialty pharma play, looks a lot like, who did I say just broke out and went sideways for a while and then took off? It's not like Ambarella. Broke out, retested, and moving. All right. Let's go to my stock of the week. Actually, before I go to my stock of the week, let's pull up TradeStation. Why do I like TradeStation so much? I'm going to show you by looking at Thinkorswim first. Thinkorswim Market Watch sucks. Okay? I can put in whatever group I want to look at. And what's really good is I could pick, let's just pick my biotech, these are my strong stocks. So I can pick that I want that scan. So it automatically scans, shows me the stocks that made it into my big movers, winners and losers, so I could see them during the day. I could be watching them on another device. Maybe I want to look at longs and shorts. This is an old list. I don't own all these stocks anymore. All right, that might be something I might want to do. The problem is I'm limited by the number of columns times the number of stocks. It's not graphically helpful to me. I don't like the picture. I don't like Market Watch. What I do like is the scanner that allows me to scan, and it treats the current bar as the end of day bar. So here's looking at my strong up and down movers. And then I look at, this is a proprietary indicator. Anything that's a +1 is strong. There's your Acacia, Ariad, I guess that's Avon, BlackBerry, Real Estate Trust, Buff. All right, so different things that I can do, all optionable. So this is, the scanner on Thinkorswim is great. Market Watch sucks. On Thinkorswim, the scanner is pretty darn good. The problem with Thinkorswim, with TradeStation scanner rather, is that it doesn't treat the current bar as end of day. It looks at the last bar. So I can't do my daily scans until the market closes. On Thinkorswim, on the other hand, the scanner treats the current bar as the end of the day, so I could scan end of day before the day is over. I like that a lot. Okay, but here's the key of TradeStation. And this is not a great resolution monitor, so I can do a lot better. I can put my stocks that I want to follow, my buys, my sells, and I can now be monitoring during the day for stocks that are going to have new signals, high close, low close dojis popping up during the day on either a daily, weekly, monthly, or quarterly symbol. I could look at stocks that have a daily reversal. Okay. I could look at the trend where it was yesterday and where it is today if there's a reversal. I could do the same thing on the weekly. So I could have 1,000 instruments here, and on one of my high resolution monitors, I could see all the columns, and I could look at John's indicators, but I could also look at my indicators, mobile breakouts from a squeeze, pocket pivots, Bible gap ups. There's no earnings on indexes, but whoops, didn't want to do that. But if I want to see when the next earnings are, here. So that thing is, this radar screen is worth the price. So I'll take that long list, of which many of them are not ready for buying, especially when I start at the worst, and I will be watching them during the day. And these filtered buys were the ones that I was most excited by. So let's now go to my stock of the week and talk about it. Again, this is for educational purposes only. Trading, especially if I talk options, involves risk. I don't warrant any return. I may or may not already have a position. I plan on taking the trades if they execute, and I'm doing this not to provide stock tips, but to openly discuss how I take the trade, why I chose a specific stock or option strategy, and where I plan on taking profits or placing stops. My pick of the week, bullish, is Bed Bath & Beyond. Here is why. See those green arrows? Everything on top is green. The one that's yellow is accumulation distribution. We're going from a phase of selling to a phase of buying, so it's in the middle. The high jump is at the top. But what did I say before? High jump only matters in an uptrend. The stock's in a downtrend. High jump is not looked at. Then there's no Bible gap up, but we did on Thursday have a mobile breakout from a squeeze. The squeeze persists. The group strength is strong, which is this line. We are in a trend up off the bottom. We've had 2 days with pocket pivots. OBV is positive, and we've had multiple positive kahunas. Earnings are already out, which is why that arrow is there. I took a position on this on Friday. I took a position because the rule for HCD that I follow is I buy at the close of the day or the open of the next day. So I had a buy order at the open on Friday. I still think this is a great trade. On the daily, a HCD 2 days ago, it's in a PPS buy. All right. OBV is heading north. It's coming out of a squeeze. This is another volume indicator where green above purple is good. On the weekly, we had a weekly HCD this week and a new weekly PPS buy. This shows up intraday even though the bar wasn't done. More reasons why on Friday I took a buy. The OBV broke above its moving average. The Bongo daily and weekly are green, which is good. So I'm going to buy it at 46.60. So I put a new buy order in above the high of the day Friday. My stop is at 44.01, which is in yet red. My target is 49.19, which is green, which is somewhere in this range over here. My risk is $2.59 per share, or 5.5%, and I've purchased 775 shares for every $2,000 I'm willing to risk. We do have a group called the Pug User Groups for the people that follow John and I. You have to pretty much be a user of HGSi to get much out of it, but if you own John's lifetime indicators, you qualify, and there will be, I'll note some about that in a second, just remind you of the seminar coming up pause it here if you want to get any of those numbers. And I will be doing a live webinar at 8 p.m. for PUG members. So you have to have the lifetime indicators for either TradeStation or Trade Navigator, although I'll only be using TradeStation. If you haven't seen an email from Mary, please reach out to her, and I'll be coming on a few minutes before 8 and doing my nightly review on Thursday night. Have a great time. See people in Florida. If you're interested in my meeting, please let me know as soon as possible. Have a great week. Thank you, and bye.